Thanks for getting up early. Set the stage for us, because we're trying to understand what's happening in the world of COVID. Demand for vessels, demand for storage. Contextualize the world that you live in for our viewers this morning.
Well, in the world of freight, I mean, currently right now for wet bulk freight, it's been a bit of a downturn over the last few months as the cuts from the OPEC Plus program have been hitting into the market, drawing down inventories, leaving less cargoes to move. However, from a dry bulk and container freight standpoint, it's actually been a growing market as demand for raw materials into China keep increasing, and the demand for exports of finished goods out of China keeps growing. One of the issues facing the container world right now is the fact that boxes are located in a variety of places around the world, not necessarily where they need to be to load out finished goods. So it is driving up container traffic massively.
Rustin, we're seeing the standoff between the U.S. and China, these tensions move beyond just rhetoric. I mean, we have, of course, the financial restrictions that are coming into play, and there's news on that in the last few hours. I wonder whether you're seeing any evidence of a tangible impact on some of the trade activity, whether that's shoring up on your end, as it were.
From a critical standpoint, we still see them buying cargoes and moving cargoes to the east. I mean, it'll be interesting to see how the Chinese refiners respond to the current increase in OSPs from the Middle East producers. The heavy sour grades and the material out of the Middle East have been a fairly substantial part of their diet, and so if that impacts their buying or not. Although, we still do see a fair amount of exports on long hauls to the east from the United States. So the U.S. exports have been over 3 million barrels a day for the last few weeks, and that doesn't seem to be declining yet, especially as the debottlenecking happens in the U.S. Gulf Coast. But their appetite...
Given the inventory situation... Oh. Sorry, go ahead. Finish what you were going to say.
I said their appetite seems to be still fairly stable at the moment. And as we move into the getting closer to the Chinese New Year, we expect to see some continued buying interest from them as they stock up.
Okay, so let's see how Iraq, Saudi, and Abu Dhabi, they've all raised their prices. So do you think that's sustainable and complemented by the unilateral move by Saudi Arabia to take 1 million barrels off the market?
Well, I think that, strategically, it does open some doors for other oil to make it into those marketplaces. It depends on what their processing diet's going to look like going into the next quarter, especially how its demand for diesel and other on-road industrial fuels are going to be present in China going into Q1. Raising the OSPs to the east and dropping them to the west, I mean, just a rebalancing where they want their oil to flow. So if we look at the Mediterranean and Europe, got a cut in their OSP, while the U.S. had a moderate increase, but I don't think it's enough to dissuade the buying from the west.
Here in the region, we had the end of the Gulf embargo on Qatar. A lot of the routes are being reopened in terms of trade and the connectivity of people. What is the impact likely to be as far as you're concerned?
Well, from an oil flow standpoint, I don't see much change going on in that regards with reopening the doors to Qatar. I mean, from a business standpoint, it makes travel to the region much easier. If you had any business in Qatar and you're leaving from a GCC state, you had to fly either through Oman or back through Turkey to get back into Qatar. So it should make at least business travel much easier, and it should make keeping the interregional relationships in a much stabler position than what they have been in the past. I mean, from a geopolitical standpoint, not that I'm an expert on those, but it does seem to create a nice tone in the area that things are getting back to a more friendlier state.
Rustin, we're trying to understand where markets move. A lot of people talked about the weakness in the dollar, the running down of inventories, and the restraint from OPEC Plus. With that alignment and perhaps a vaccine rollout, where do you think prices can get to? And I ask that because Ed Morse is talking about $60 because of the swing producer status taken on by Saudi. Can we break $60?
I think the market could break $60, but to get there, I think we need to have the dollar needs to weaken in order to keep the market supported. You need to have OPEC maintain its discipline around its supplying to the market. And also, I think you need to see refinery margins continue their upward trend to keep the demand going from the end user of the crude oil. Personally do believe that a $60 price target is well in the picture at the moment. The momentum's there on the trade flow. The dollar weakness is helping move that along. And of course, Saudi's cuts help as well. But there are some headwinds that we can see coming in on the demand side if COVID restrictions continue and expand. As we've seen the announcements out of China with them locking down certain provinces. That could provide to be a very large headwind at the moment. What is the Biden administration going to do in regards to Iran and Venezuela? And also, what does Biden do around the U.S. shale producers? Do we see a resurgence of environmental regulation that reduces the capacity to grow in that marketplace?